Well, welcome everyone to CapEd Credit Union Presents Lunch Money. This is our final Lunch Money webinar for the summer. And we do have others that are recorded, and we have Dan Sullivan with us here today. Dan is CapEd's mortgage loan manager, and unfortunately, we will Kittie Shervik won't be able to join us for this webinar, but Dan has incredible information for you today. And in the chat feature, I would encourage everyone along the way to type a question into the chat feature so that Dan can answer those towards the end, or he'll take them throughout the webinar. So please feel free to type in the chat. I'm Lisa Hamilton. I'm CapEd Credit Union's business development manager. And I have Todd Christensen's name here because I opened it up with under his credentials, but I am Lisa Hamilton, happy to be with you today. And I'm excited about this topic, Dan, because we're all thinking about the future and how can we be in a best position to retire and just be our financial well-being. We want to make sure that we have everything ready to go. So the topic today is it's best not to have a mortgage expense in retirement. How do you ensure this future freedom? So I'm excited to hear what you have to say today, Dan, and I'm going to drop off and let you take it from here. So welcome, everyone.
Great, thanks, Lisa. We've had 4 of these lunch money seminars that have been tied around mortgage. We talked about the state of the mortgage markets in both the Treasure Valley and the Magic Valley. Had a couple of realtors on, and then we talked about how to first-time home buyers and how to get into a home. We talked about on Tuesday how.
So now might be a good time for everyone to type questions in the chat feature that you have, and looks like Dan's back.
Are you back? Okay, I didn't go anywhere.
We can hear you now.
Okay. We were talking about retirement planning, and when you get into probably even into your mid 40s, it's really time to start looking at retirement planning. Some people wake up one day, I think in their late 50s, and all of a sudden understand or figure out that they're about to retire. And but just quickly, this isn't really about retirement plan. It's more about just the mortgage. But let's talk about retirement planning real quick. Some of the things that your retirement plan should include are income. Obviously, how are you going to retire and survive financially? So hopefully you've already delved into 401ks, IRAs, you understand pensions and if available, and then you get your Social Security, and so hopefully you've started to look at the income that you're going to have after you retire. You also want to look at healthcare. If you retire before age 65, certainly your healthcare is a huge concern, because you get to bridge that gap between whatever age you retire at and age 65, when your Medicare and Medicaid starts kicking in. So that can be very, very expensive. If you plan to retire at 63, you've got a couple of years that you may have to pay for some pretty expensive insurance. Debt planning is something we're going to delve into here in a few moments, but certainly, retiring with good income, but also having a lot of debts is not optimal. So I want to start thinking about how you're going to pay your debt down and get close to zero, and we'll talk about that more. Estate planning is something that I think everybody should look into. You want to, what's going to happen once you're gone to your house, your assets, your investments? Are they going to end up going where you want them to go? Is there ways to transfer your wealth, your assets to your heirs? which are tax-free or at least as low tax as possible. So estate plan is not something we're really going to look at today, but it's something that you should probably put some consideration into it and start researching. And then the last thing is, what are you going to do for fun when you retire? People ask me, I still have quite a few years before retirement, but people say, what are you going to do when you retire? And so what are you going to do to keep yourself busy? And certainly I'm going to do a lot more fishing and skiing, and I have a lot of things planned, but a lot of people retire and don't know what they're going to do. So as far as what we're concerned with today, we're going to talk about how to retire your mortgage before you retire. And there again, like I said, I'm going to offer a number of options, but let's bear with me. I've got some ideas here. So obviously you can pay extra. So you let's say you have $200,000 mortgage and you got 18 years left on it. You can just simply pay more and pay off your loan. If you've recently taken out a 30-year mortgage, and we'll say your payment's $1,000 a month for the principal and interest payment, not including taxes and insurance, by paying 55% more, or about $1,550, you're going to cut your remaining term in half. Now, as you get further into your loan, you need to increase that number more. If you've got 4 or 5 years left and you want to pay it off in half that time, then you need to make almost double payments. But we can certainly help you by figuring out how much time when do you want to pay it off, and how much payment do you need to make. So if you got a $200,000 mortgage, you've been paying on it for 12 years, you got 18 years left, and you want to retire in 7, we can show you how much to pay per month to pay off your loan in 7 years. And that's a quick call to one of our loan officers or to our servicing department, or myself. Anybody can help you. There's also calculators online that will help you figure that out. So there's a mortgage calculator at CapEd. Lisa?
Yes. Hey, Dan, I think when we had the technical glitch, it stopped sharing your screen.
Oh.
So
sure.
We're not able to see your beautiful PowerPoint presentation.
Oh. Well, let's see if we can fix that.
Thank you.
How about?
Yes.
Now.
There we go. Thank you.
Okay. Sorry about that. So you can certainly, to pay off your mortgage early, you can simply make a bigger payment. You can also refinance to a shorter term. So paying extra on your mortgage requires that you are disciplined to do that. And some people are very disciplined financially. Some people are not, and that's something that you need to answer for yourself. But refinancing to a shorter term, let's say you want to, back to that scenario, you owe $200,000, you got 18 years left on your 30-year mortgage, you want to retire in 7 years. At CapEd, we can actually do a custom mortgage. We can do a 7-year mortgage. We can do a 6.5-year mortgage. So it may make sense to do that. Your interest rate on a shorter term mortgage is better. So it might behoove you to refinance to a shorter term. The other side of that is, if you refinance to a shorter term, you have a larger payment that you're stuck with. You have to make that larger payment every month, and so if something happens down the road, if your spouse loses their job, if your income decreases, you still have a short-term loan with a large payment. So paying extra on your existing mortgage might be a better deal. Getting a better interest rate and forcing yourself into a larger payment on a shorter term might be a better deal. That's something that the individual kind of has to figure out on their own, and my loan officers can certainly help you with that decision making. Plan to downsize your home at retirement. A lot of people do this. They have the family home, 4 bedrooms, 3 baths, and they find by the time they're in retirement that that they're empty nesters. So certainly, if you aren't going to pay off your mortgage before you retire, then maybe look at downsizing your home and buying something that your retirement home. And if it costs less, you may be able to purchase that with equity in the larger family home that you have. Move to rural Missouri. Now, this is kind of a joke, but also at the same time, we have hundreds and hundreds of people moving to the Treasure Valley from places like Portland, Seattle, San Francisco, LA, San Diego. And they're moving here because of both the lifestyle and the fact that homes are much cheaper here still than they are in the markets they're coming from. So they're selling their homes in the Bay Area, moving to Boise, and with the equity they have in their home in San Jose, they're able to buy a house here. Though that opportunity still exists, you can. I said rural Missouri. My wife is from rural Missouri, and homes in northeastern Missouri and Monroe City, Missouri, are about half the price they are in Boise, Idaho, right now. So it's an option. You can move to some place where you can retire better with the funds you have. And there's there are a lot of areas in the United States that fall into that. So and the other one I want to talk about was invest your extra funds elsewhere. So instead of making a larger payment on your house, let's talk about the possibility of investing extra money if you have it available elsewhere. So let's say you have an extra $500 a month that is available to you. You have that in your budget. And so something you can do is you can put $500 a month into a mutual fund. And if we look at a mutual fund over a long term, over the last 30 years or so, the average earning on that is 6-7%, somewhere in there. Lately, we've been doing much better than that, but you need to look at this kind of long term. So invest $500 a month, every month, into a mutual fund earning 7%. And in 15 years, the value of that investment is $158,000. So now you've invested $500 a month for 15 years in this scenario. You've got $90,000 in there, and so you have $68,000 in capital gains, and you'll pay some taxes on that. But it's another way to kind of look at the same thing. You can make larger payments on your mortgage, or you can invest the money and earn a little bit higher interest than what you're paying on your mortgage. The thing I like about this one is, and this is something that we do at my house, is we've invested money into a mutual fund. Let's say down the road something bad happens. You're in a horrible accident, you have a catastrophic illness, something bad happens to you. If you've put $500 a month into your mortgage payment every month, you've paid down your mortgage and you have a lot of equity in your home. But if you're in a situation where you can't work, you may not be able to get that money out of your house. The money sitting in your equity in the house, and the only way to get it out is to sell the house, which you may or not want to do, or to borrow against it, which you may not be able to do. You put the money into a mutual fund, as I'm suggesting here, then that money is yours. And if you get to a situation where you needed money because something very bad has happened, then that money is very accessible to you. Now, there again, we go back to kind of that whole discipline. If you're a person who has a hard time having a bunch of money sitting on the sideline, and you decide down the road that you know yourself, and down the road you may want to buy a boat. This may not be the best idea for you. So let's talk about some other ideas. This is there again, purchase a $70,000 building lot up in Cascade, Donley. I throw these out because I know McCall's going nuts right now, and people are looking at Cascade, Donley, New Meadows, different places like that, and the real estate in those areas is doing very well. So purchasing a building lot in one of those areas, and be smart about it. If you're going to buy a lot somewhere, it needs to be somewhere where you think that 5, 10, 15 years down the road, it's going to be worth far more than what it is today. So if you're going to buy a lot out in the middle of absolutely nowhere, what's going to drive that value up? Right now, we know that McCall is pricing the values there are pricing a lot of people out of it. So Cascade, Donley, New Meadows, some of those areas around there. There's also a lot of areas around the state that are similar. But let me show you the math here real quick. So let's say you buy a $70,000 lot. Now you're going to have to put a down payment on it, and so let's say this requires an investment of say $21,000 to $24,000, $500 for principal, interest, taxes on the loan. And the reason I say take a loan is because you may not have $70,000 in your pocket, and also you are leveraging your money. So you buy the loan, or buy the lot, you take out a lot loan, and then down the road, if that increases by 5%, which is pretty good for land values, about what we see over a long term. If you buy it for $70,000, it increases at 5%, then you walk away with $147,000. And there again, you're gonna have some capital gains, but you've leveraged your money and been able to do expand that. Now, keep in mind that both with the mutual fund idea and the lot in buying real estate or something like that, values go up and down, and so you may not, you may have to sell at a time when values are down, so there is risk in both those ideas. Other thing you can do is purchase an investment property, and rental home or commercial property. This is you buy a rental property, and it appreciates in value, and in theory you have somebody else, the renter who's in that home, or the renters who is in that office space or whatever you choose to buy, is making your payment for you. So you still have to come up with a down payment. You're still on the hook for if the home's not rented, if the office space isn't rented, you may have to make some payments there, and it's still the real estate market, which is up and down. So there are risks involved in that, but certainly another option. Gold, silver, other commodities. I don't really understand these, and so I just put them up as an option. But there's a lot of people who invest in gold or silver or other commodities, and so long term, over the next 5, 10, 15 years, you may do very well by investing in something along those lines. Something that they might be more fun than purchasing a rental home or a stock, antiques, classic cars, things like that. Put your money into something that's going to appreciate in value, and sit back and but also maybe have something you can enjoy. A few other methods I want to point out, and so certainly, if, let's say, Aunt Mary left you $20,000, and so you take that $20,000 that you found, and you put it down on your principal reduction on your mortgage. If you're paying 3% interest on your mortgage right now, then that $20,000 is an absolute guaranteed 3% investment. I mean, you've essentially saved yourself 3%. So that's like putting $20,000 in the market, 3% absolutely guaranteed. You're absolutely going to get that return as long as you have a mortgage. And so that is about as safe as you can get. Now, here's kind of a dirty little secret that I'll share is I tell people all the time, I have done this same discussion on radio shows and in front of other groups of people. And my wife and I have done okay on saving for retirement. We're going to be just fine in retirement, and hopefully have the house paid for. And I get my paycheck and I use it all to get them. Then if there's anything left over, I pay extra on any debt that we may have. And so the only way that I can really save money is payroll deducted savings. And that's working very, very well for me for the last 35 years since I graduated from college. I invest heavily into my 401k. I also, CapEd has I have the ability to put money directly into savings. And so I, like many people, can't, when I get my paycheck, I spend it all. And so if it wasn't for payroll deducted savings, money that I never see, then I wouldn't be anywhere near where I am today. And so that's money that I just pretend is never there. And I have a savings account, a 401k, and I've done that at every job I've had since I got my first job right out of college. So if you have problems with saving, look into your company's payroll deducted savings programs. Now, some of you might be out there saying, these are all great ideas, but you're talking about $500 a month, and you're talking about chunks of money on different things, but I have so much debt that I can't even breathe, and that happens. And when I see that, we've all been there at some point in our lives. We understand. So I'm going to really quick talk about how to snowball your debt into paying off your debt. So the snowball effect is, when a snowball starts rolling at the top of the hill, it's small and doesn't roll very fast. But as it goes down the hill, it picks up more snow. It grows. It moves faster and faster. So snowballing your debts is an idea where if you have too much debt, you start with the smallest payment, so the smallest debt you have, the smallest amount you have. So let's say you have a $200 credit card and a Home Depot card, and it's got a $20 payment. Pay that thing off. If you can pay an extra $5, $10, whatever it is. Let's say you pay an extra $10. So instead of paying $20 a month, you pay $30 a month. You pay off that one. You get the $200 paid off, and then you have $30 in your budget. And so you look at the next one. You got a $1,500 credit card, and so you pay the minimum monthly payment on that credit card plus the $30 that you're not paying to Home Depot anymore, and you pay that off. Then you take the total of that credit card payment plus the $30, and you go after the $2,500 debt you have. And so you start at the smallest, you pay it off, and then every month every time you pay off something, you take the funds that you were using to pay off that smaller debt and go after a bigger debt. And so the snowball starts to work, and as it rolls downhill, it picks up steam, and pretty soon you find that you are paying off debts really fast. Starts kind of slow, but it pays off debts very, very quickly. So if you don't have any extra money, then work on your debts, and and pay them off, and then eventually you're going to get to the point where the last debt you have is your mortgage, and you can pay that off. So, and then the one that is kind of needs to be said to some people at some times is you need to create a budget, and you need to live within that budget. So live within your means, or even live below your means. And we all want to keep up with the Joneses. We all want to have the nice house, the nice furniture, all the toys. But remember that you need to create a budget and live within that budget. And it's the guy with the most toys isn't necessarily the winner. I think it's the person who retires the best, with the ability to retire maybe early and retire with lots of disposable income, and the ability to travel and enjoy your life after retirement. So anyway, hopefully somewhere in what I have shown here, there's something that works for you. And I want to put up, if you have questions, you can certainly reach out to me, and here's my contact information. Lisa, are there any questions that came through the chat?
Yeah, Dan, can you hear me okay?
Yes.
Okay. One question is, and if you can speak to this, I actually receive quite a few questions about this as well. So I'm happy that this question came in, is if you can explain reverse mortgages, and if CapEd does offer reverse mortgages,
Mm-hmm.
maybe the pros and cons. I know that I've actually have some people, just friends, where their parents have taken out a reverse mortgage, and then, I don't want to tell you their situation, but it maybe wasn't the best experience for them. So I'm curious about just some advice on that.
Sure, I'd be happy to. CapEd doesn't offer a reverse mortgage, but I am very familiar with them, and like a lot of loan programs, the reverse mortgage is a tool. It's a powerful tool, and like a chainsaw, if you use a chainsaw correctly, it will help you cut down the tree very quickly. If you misuse it, you can lose a leg. So a reverse mortgage is a tool much like that. If used correctly for the right person at the right time, it's very helpful. If you use it for the wrong situation, it can be very costly. A reverse mortgage is a program actually administered by FHA, and so the government, and it allows you to refinance your house or even purchase a house, and you have no payments. So you can, a lot of people will use it. They've paid off their house, or they've paid their house down. I think you need to be 65, if I remember correctly, to do a reverse mortgage. And so it's really for the person or the couple who maybe didn't have the opportunity to save enough money for retirement. Now they're living on Social Security. They really don't have the money to do anything, in some cases, even kind of get by, but they have a ton of equity in their house. They can take out a reverse mortgage, and with the reverse mortgage, they can either receive a lump sum payment or a monthly payment from the mortgage company back to them, and they don't have any monthly payments. You still got to pay your taxes and your insurance, but so every month the loan amount goes up because you're not making any payments, and you're accruing the principal and interest on that loan. So let's say you have an individual who didn't have the opportunity to save for retirement. They're barely barely squeaking by on Social Security. They have a ton of equity in their house. They can go do a reverse mortgage and suddenly have a pretty good income and from their home, and that and they can live comfortably. And when they pass or when they have to move out of the home because of they need greater medical care, so they go into a nursing home. The home needs to be sold and the balance paid off. So and depending on how long you live, you could get into a situation where you owe more than the house is worth, but that's the risk that FHA takes on these loans. They're insured by FHA. Does that make sense?
Yeah, that's very helpful. So basically they're drawing off of that equity. It's becoming income for them, and they are not having to make additional payments to their mortgage at that time. So if they still have, a first mortgage, they're making those payments, and the reverse mortgage is separate. That's just providing some income to them.
But the reverse mortgage actually would become the new first mortgage.
Oh,
so,
okay.
Let's say that your house is worth $400,000, you owe $100,000 on your first mortgage. You could do a reverse mortgage up to, I want to say it's 70%. So you can borrow 70% of the value of the home, and there's a couple different ways you can take those funds, but a lot of people will take them as a monthly draw. So
okay.
So you start out with you owe $100,000, and then the first month they send you $1,500 a month, for instance.
Okay.
Then every month your principal balance is going up by $1,500 plus the interest that accrues on the loan. And so every month your balance goes up rather than a traditional mortgage where your balance goes down.
Mm-hmm.
And there again, for the right person in the right situation, it can be a very powerful tool that gives somebody who doesn't have the ability to really live comfortably a lot more flexibility, a lot of extra income.
Sure.
Some people take them out because they think it's a good deal, and they don't necessarily need the income, and so they're kind of eating away at the equity in their home. There's times where if if you're misusing the tool, it can bite you.
Right. Yeah, I would encourage everyone to, reach out to Dan. His phone number is listed on that final page there, either email or call, just to get, just talk through your situation first. Reach out to your accountant, your financial planner. Your whole presentation, Dan, was great information. You're talking about budgeting and getting to that point. So if I could, Dan, if I could share my screen just for a moment, I did want to show something.
Yep.
Okay. Let's see. So what I wanted to share was on CapEd's page. Are you able to see my screen?
Yes.
Okay, so I just wanted to let everyone know, if you visit capedcu.com, the snowball method that Dan was talking to about paying down your debt, if you go to capedcu.com and go to, I'm looking for educational resources, we have It's a Money Thing. We also have Learn About Mortgages Here, where Dan is speaking to that on some of the videos, but It's a Money Thing. all of these content packs are free for anyone to come to our site. And we have budgeting and saving. There's numerous videos and handouts, even if you just want to learn for yourself, or if you want to share those, if you're an educator or a parent, and just share this information. And under the loans section, we actually have one here that talks about paying off your debt. And there's the different, the snowball method is listed here, as well as the avalanche method, or a consolidation type of loan. So great information here. The videos, they're not made for children. They're animated, but it's wonderful information, and it's just spot on. So I would encourage everyone to visit that area and learn more about budgeting and savings, and get ready, for retirement. Start early. The sooner you start, the better. And pay yourself first, so you can get to that nice position when you are ready to retire. Dan, thank you so much for all of the information. We couldn't have done this webinar series without you and Kitty. We appreciate that content that you brought and your expertise. For those of you that are tuning in today, this webinar will be recorded and available. And currently, we have past webinars that are on our site that are already recorded, and you can go back and watch those and share them with people who and they go back to the very beginning, first date with Raymond Yee with Sally Mae, and then you can go down and numerous topics there. So Dan, any closing comments before we finish out this final webinar for the summer?
Just, if you want to chat about how to pay off your mortgage, give me your, reach out to me. I'd be happy to help anybody with that. It's, something that's near and dear to my heart. And I've been in the industry of make mortgages my entire career, but I want to also help people pay it off and get to that point in their life where you have some financial stability and the ability to retire. So
yeah, appreciate that. I like the educational piece. Let's get everybody there.
Yep.
So thank you so much. And for all of you who tuned in, have a wonderful day. Enjoy the 4th of July holiday. Be safe. Enjoy your friends and family. And with that, we'll bring this to a close. Have a good day.
Thanks, Lisa.
Bye.